With me is Councilmember Falcone and Councilmember Schneider. I'm Roger Horton, the chair of the committee. Today's agenda consists of 3 items: the Redevelopment Agency fiscal year 2009 interim financials, the airport terminal project financing update, and the January 2009 investment report. We'll begin with item number 1, the RDA fiscal year 2009 interim financials. Mr. Pearson.
Thank you, Mr. Chair. Bob Pearson, Finance Director. Good afternoon, Mr. Chair, members of the committee. The interim financial statements for the Redevelopment Agency, this is for the 6 months ended December 31st. And I just really have a few comments because, as you know, unlike the city's budget, the revenue side of the Redevelopment Agency budget is fairly straightforward. Primarily, of course, we're looking at one revenue source, which is the incremental property taxes received by the agency. And if you look at page 1 of the actual statements, you will see that through 50% of the fiscal year, that is through December 31st, we had received about 65% of the annual budget for the Redevelopment Agency's incremental property taxes. That's not unusual. As you know, the property tax payments are due in December and March, and there are a number of property owners that choose to pay their entire annual property tax bill in December. And so it is not unusual at all that we have well over 50% of the revenue in the bank by the end of December. Having said that, I think from the analysis that we have done to date and the information that we have on the property taxes for the RDA, we certainly do expect to meet or exceed budget on the property tax revenue for this year. So we're very comfortable with that. The other minor or less significant revenue sources for the agency, you see that investment income, despite the historically low level of interest rates, we have already exceeded the annual budget for investment income, an annual budget of $200,000, and we've received through 6 months about $228,000. That is as much a result of the conservative budgeting of the investment income as it is anything else, because, as to repeat myself, we are in the midst of historically low interest rates. I would certainly not expect to be double the 6-month number by the end of the year, given the recent dramatic decline in interest rates, and we certainly don't expect that to change over the next 6 months from all indications we're hearing from both the Federal Reserve Bank and the federal government. And those are really the only 2 significant revenue sources for the agency. As usual, the interim financial statements do include information, obviously, on the expenditure side as well. And on page 3, you will see the capital projects fund, where the in some of the individual projects are listed there, showing you what has been spent to date on those projects. And if you have questions on that side of the shop, I will be happy to refer them to my good friend, Mr. Brian Bossy.
Actually, I do have a question on page 2. Picking up on what you were saying about the revenues, the way the revenues come in, if you look at the total fund sources percent of budget, 95.92% in the far right column versus 63.94%. This is the general fund versus the housing fund.
Yes.
Is there a different way of distributing those 2 funds?
No. In fact, if you look at the incremental property tax for both of those funds, you will note that both of them are exactly at 65.06%.
Right.
And that's because we budget and allocate those incremental property taxes on exactly the same basis, which is the 80%, 20% provided for in state law. I think the difference that you'll see is that with the housing fund, you will see that the interest on loans, not the investment income, but that is really already double the amount that was budgeted, and so that results in a higher year-to-date percentage in the housing fund than it does in the RDA's general fund.
Makes sense. Are there any questions or comments? And if not, is there a motion?
I'll move approval.
Was there a second? Moved and seconded. All those in favor say aye.
Aye.
Aye. Motion carries. All right. And now, would you like to move to previous item 3?
I would, Mr. Chair.
Okay, we're going to revise the agenda now then, and we're going to move to the January 2009 investment report, which is out of order, and then we'll finish up today with the airport terminal project funding. Proceed.
Thank you, Mr. Chair. As you know, this is the investment report for the 7 months ended January 31st, 2009, and as it is not a quarter-end report, we have not provided you with a written analysis pursuant to our standard procedure. But if you look at page 1 of the statements, it's entitled the Activity and Interest Report. You can see that during the month of January, the only purchases or deposits we made were deposits into the State of California's Local Agency Investment Fund, $18.8 million. On the bottom half of that page, you'll see the sales, maturities, calls, and withdrawals, and you can see that we did have 3 of our callable federal agency investments were called during the month of January. We did have 3 LAIF withdrawals. And then in addition, we did have 1 maturity of a Federal Farm Credit Bank $2 million piece. And then on the right-hand side, you can see that during the month of January, we did earn and accrue just over $500,000 in investment income, $510,000, dollars. And then on the RDA, the redevelopment agency side, which is invested solely in LAIF, about $42,000 of investment income there. On page 2 of the report, you see, as always, the comparison for the month ended January 31st in this case and the prior month end. And you can see that if you look at the yield to maturity, you see that 30 days later, roughly, the portfolio yield had dropped from about 4.04% to about 3.8%. And the average days to maturity had dropped considerably from 471 days down to 388 days, and I think that is a result of a decision to stay short in the current environment. That there just certainly is no value at this point in going out on the yield curve, anything past a year and a half, 2 years maximum, and so that's really where we are positioned. I would say that. During the month of February and into March, we certainly will look to be a little more active in getting into the market now that it seems to have stabilized a bit, albeit at historically low levels. It has, because when you hit bottom, you hit zero. Yeah. So that's really a summary of where we stood at January 31st, and I'd certainly be glad to answer any questions on that.
Just one question, Bob. On page 4, I noticed that the 2 Wells investments are AA3.
Right.
Is that some kind of a trend on that you've noticed?
Actually, it is. I think it was last month, the December quarter-end report, where we provide you with the written analysis. We described for you on our corporate bonds the Wells Fargo, the Toyota Motor Credit, which, of course, is not the automaker, it's the financing arm, and the General Electric Capital Corporation. In each of those cases, we have been watching the credit trends on those issues very carefully. And yes, I mean, we are watching that carefully because there is some concern, certainly in the financial sector, as we know, over the stability of some of the major money center banks, including Wells. We feel confident at this point that the ratings are still obviously well within our range at AA, A3 and AA. But there is a concern because if they're put on negative credit watch, then we would certainly consider selling them at that point.
Mr. Koenig?
Is there any speculation that you have? I know that this is an unknown for all of us, but there is talk of albeit temporarily, maybe the government taking over the banks. They use the N word, the nationalizing. But and even if it's for a year or two, what does that do to these credit ratings? Because in terms of shareholders, the price goes to zero, and people lose their money, whether it comes back when the banks go back into private hands or not. Who knows? But what does it do to these ratings? Do we have any idea?
Well, I think, Councilmember Falcone, I think that it's hard to answer that because we're kind of in uncharted territory. But first of all, unlike equity investments, stock investments, and I know you know this, I'm just saying this for the benefit of other people who may be happy to be reassured that we're not talking about stocks or equity where we would be essentially wiped out if the N-word, nationalization, I should say, because, yes, there are multiple N-words. If the banks were temporarily nationalized and shareholder equity was eliminated, that would not affect us because we are bondholders, which means that we're creditors, not. And I think that
right, and that's a good explanation for people. I know, but that's why I focused in on the on the bond rating.
And I honestly, the answer is I honestly don't know because on the one hand, one could argue that it's going to negatively impact credit ratings because of the uncertainty involved with the nationalization and how that would proceed and how these banks would exit from that kind of conservatorship and what they would look like upon reestablishment. But the other side of it is it could enhance credit ratings because now all of a sudden Uncle Sam is guaranteeing essentially these things. I tend to believe that our investments in these bonds of the banks, and to be fair, I mean the good news is I guess Wells Fargo is really the only bank in which we own these bonds.
Right.
And it's $4 million, which is something in the neighborhood of about 2% of the overall portfolio, and I'd also point out that one of those bonds matures in August of 2010 and the other in January of 2011. So they have about a year and a half to go on one and essentially 2 on the other. We've actually had internal discussions in the last couple weeks about just selling them now and eliminating the exposure. The fact of the matter is that with their current interest rate, credit ratings still up there at AA, and with the fact that the yield on these two pieces is well over 5%. Well, one of them's at 5%, and the one's at 5.25%. We could sell them at a premium, at a profit, if you will. But the downside,
it's at 5% right now.
What are you going to get?
well, right now we're going to get about 0.3%.
Right.
But the good news is because these are the yield on these is so high, we would sell them at a significant gain, and in theory, then that we take that gain in lieu of the stream of interest that we would earn over the rest of the life of the bond. I mean, that's how they're priced essentially. So in a sense, we would capture most, not all, but most of that 5% income stream over the remaining life of the bond, and then take that money now as opposed to taking it over the remaining life. So, we've been through things like this before, at least a little bit in terms of the Orange County bankruptcy and all of that. And for us, a few extra basis points of yield is certainly not worth. We've learned our lesson well. It's certainly not worth the exposure that this kind of thing might bring.
Well, I think in light of the exposure that having those thoughts very seriously has tremendous merit, and I see Mr. Armstrong in the audience here, so I would be favorably disposed to encourage you to think more about that.
Okay, any further questions of Bob or comments? If not, is there a motion?
I'll move to consent.
Second.
Okay, all those in favor, say aye.
Aye.
Motion carries. All right. And now we move on to the exciting item today. Some of these agendas are possibly not the most exciting television show that you could watch, but today's show is a little bit more exciting for those of us that are involved in this thing. We've been involved with the planning for the airport terminal project for a long time now, years at this point. And so today is a kind of a decision point that we need to review very carefully, and I think we're going to have a presentation from the airport people, and then we'll decide where we want to take it.
Do we have anything in staff report?
We have a staff report.
It's the Bob Show.
It's the Bob and Bob Show.
Okay. Mr. Pearson, over to you then.
Thank you, Mr. Chair, members of the committee. Mr. Chair, I couldn't agree with you more that this is a very significant item and a project which has been certainly more than years, at least a decade in the making, and we are thankfully appear to be rapidly approaching the point where this project starts to become reality. As you recall, back in on December 23rd, 2008, staff came to the full council and received authorization at that time, December of 08, to proceed with the issuance of tax-exempt bonds to finance the vast majority of the airport terminal project. And just to refresh everyone's memory, the project is really going to be funded from a combination of multiple sources, the largest of which is clearly the issuance of the tax-exempt debt. But in addition, there are substantial amounts, over $10 million of FAA grant money. There are passenger facility charge revenues, which is the per segment charge that air travelers pay for each segment up to two segments that they pay at $4.50 per segment, and there's also the customer facility charge, which is a $10 per rental car contract that we charge for airport car rentals, and there's also a portion of the department's own funds that would go into the project. But again, clearly the largest piece of the financing for this project are tax-exempt bonds, and council authorized us to proceed on December 23rd. At that time, we told the council that that it was unlikely, despite that authorization, it was unlikely that we would be in a position to issue the debt at least until the first quarter of 2009, because frankly the bond market at that time was completely unsettled. In fact, it had basically, the municipal bond market had basically frozen. Nothing was getting sold, and maybe the one or two few things that were getting sold at interest rates that we certainly would not consider acceptable. At that time, we told you that if we were going to be in the market in that time in December, that we would probably be looking at an interest rate as much as 7.5% to 7.75%, and that on a $60 million bond deal, each percent represents $600,000 a year in additional interest, and we just did not feel that market was something that we wanted to accept when the entire life of the project, we had assumed a 6% interest rate as our sort of planning bogey. And thinking, frankly, all that time that was a conservative assumption and that we would be able to sell the bonds at less than 6%. Then, of course, the world changed, and we were not able to do that. So that's where we were last time we talked to the full council in December. We got the authorization, but we assured the council that despite the confidence shown by the council in giving us that authorization, that we had no intention of proceeding until we could find a market for the bonds that was more comparable to historical levels. And so what brings us back here today is the fact that, as you know, back on December 16th, we opened the bids for the main construction contract for the terminal project. And the bad news that we were looking at in terms of the bond market was in large measure offset by the good news that we got when we opened the bids. The bids came in substantially lower than the engineer's estimate, as much as $12 million below the engineer's estimate, low bid of about $32.5 million. And those bids that were opened on 29%, $12 million, yes, below engineer's estimate. The bids that were opened on December 16th were good per the bid documents for 90 days. That means that the bids that we now have in hand are only good through March 16th. And since that is about 2.5 weeks away, we have reached a decision point where we're going to have to decide whether or not to award based on those bids or to consider rejecting the bids and going back out to bid a second time. And the reason this is a decision point is because we have yet to be able to sell the bonds. And so the question will be, recognizing that there is no way that we're going to be able to sell the bonds now prior to the March 16th bid expiration deadline, we have to jointly come to a decision as to whether we want to award the bids without having issued the debt. And
Question for you here,
yeah,
Bob.
and I'm going to go through the components of that analysis for you, but I wanted to lay out the sort of the question
Sure.
that we're going to be talking about over the next few minutes.
Yeah.
Based on the way you just said, we haven't yet been able to sell the bonds, leads me to ask you, have we tried? I mean, are you speculating that because the market is so bad, still so bad, it's unfrozen to some extent, I guess, but have you actively been trying to sell the bonds?
No is the answer,
Okay.
and I'm going to talk about that in
Because
a
the way
little
you
bit more.
phrased it led me to believe that we were actively out there trying.
No.
Okay.
And that's a very good point. We have not yet tried. In fact, I'll sort of speak to that now. After we came to you on the 23rd, we just recognized that with the holidays and all that, Wall Street, even in normal times, shuts down over the holidays. So we had looked, as we had told you we would, to the first quarter of 2009, which, of course, we're smack dab in the middle of. Over the course since the new year, the market has recovered substantially, and I'm going to give you some empirical data that I believe evidences that. But we, back in December, essentially put the deal on hold, and we have not been trying. We still have probably about 3 to 5 weeks of work to do before we will be ready to go to the market. And I'm going to tell you specifically what those constraints are that give us a 3 to 5 week time frame to get to market. Right. That's the point. And that's why we're here. There are two issues at hand in terms of the constraints on issuing the bonds now. One is that we are still waiting our rating from Standard & Poor's. And we've got our Moody's rating in hand, and it was an excellent rating, and I know I sent that out to each of the council members back in December. Standard & Poor's has taken a different approach to this deal. They basically have told us that they believe it to be in our best interests to have selected the contractor prior to asking them for our rating. Okay, now that I've been in this business like 30 years, done many bid bond deals. I have never heard of this from one of the rating agencies. It's because they tell us it's because one of their primary concerns in rating this deal is the construction delay risk. And it's the way the deal is structured. Now, you'll recall that this deal is going to be guaranteed by the general fund. But besides that general fund guarantee, the underlying security for this deal is essentially a lease on the new terminal. That security guarantee does not become binding until the new terminal goes into service. Okay? So what they're concerned about is that if the construction period takes longer than the 2+ years that we're anticipating, we hit unexpected delays, soils conditions, you name it, rain, weather, whatever, and it takes 2.5 to 3 years to complete construction, then there would be a window of about 6 to 9 months where the bondholders would not be properly secured. And so Standard & Poor's is saying, if you want us to, we will issue your rating as soon as you give us the word. We have all the financial information we need on it. But we think it's in your best interest to wait until you have a contractor, because otherwise we're telling you now we're going to have to knock the deal down, the rating, 1 notch. But if we know who the contractor is, then we think we'll be a notch higher than would otherwise be the case. They even went so far as to pay the overnight freight charges to have us FedEx the plans to them, and what I don't know, somebody told me like 40 pounds worth of plans or something like that they paid to have overnighted to their consultant that they had hired to analyze the project construction details. They want their consultant to be able to talk to our contractor so that they can get more comfortable with the construction risks. And so, again, we could go to Standard & Poor's and we could say, no, we need our rating right now. And they'd basically say, okay, but it's going to be a notch lower than it would otherwise be. I think personally, given the fact that ratings directly affect interest rates, that that it's in our best interest to wait and get that rating. The other piece is we still need to complete the primary disclosure, bond disclosure, market disclosure document, which is called the Preliminary Official Statement. We had finished it by December, but because now 6 weeks have passed, we have to make sure we have to go back through it and make sure that it's still up to date. Our best estimate is that we can be ready to go to market in 3 to 5 weeks, which would be about 3 weeks after we would award bid, if we were to award. And I must say that we were planning, when I walked into this room today, I was under the impression that we would, with your recommendation, we would be back to the full council next week for bid award. I've been told now that that is going to be delayed 1 week for unrelated reasons. So it won't be until the 10th of March, which in a way is good because it means that we're that much closer to issuing debt. But the issue here at hand is, and the risk that the committee and eventually maybe the council needs to understand is that there would be a 2 to 3 week gap, maybe 4, I don't know, between the time we award the bid and the time we get to the bond market. Now, there's a risk there, obviously, because if something were to happen dramatic in the interim and the bond market would dry up again, there is a chance that we would have just awarded roughly $40 million in contracts and not have the bond financing to pay it. Now, the good news is we have an investment portfolio and a cash flow from that portfolio investments that would allow us to self-fund the construction of this project for a reasonable period of time, 3 to 6 months. I've talked to the engineers on the project. They're expecting that maybe over the first 5 months of the project, our cash flow need for the project would be maybe up to $5 million in that range. And certainly we could afford to self-fund that level of involvement before selling the bonds. I want to talk now, if I could, about the bond market, because I think that's a critical piece. I mean, what is...
That is the tax ruling. The tax ruling.
AMT.
Yes. And that's what I want to talk about right now is the AMT piece and also the current condition of the market. One of the things we told the council in December when we asked for and received the authorization to sell the bonds was that it appeared at the time as if the stimulus package that was wending its way early on through Congress was going to include a temporary change to federal tax law, which would be of great benefit to us in this deal. And that is that despite the fact that they are municipal bonds and tax-exempt bonds, airport bonds for many, many, many years, the income earned by the bondholders when they buy those bonds is tax exempt, but it was subject to the alternative minimum tax. It was considered what they call a preference item, and therefore it was included in the alternative minimum tax calculations. AMT bonds, as they're called, in the market recently have been selling for as much as 1 full % more than comparable non-AMT tax-exempt bonds. That was one of the things that, when we talked to you in December, that had pushed the interest rate up to 7.5% or 7.75%, was because these were at that point AMT bonds. Well, the American Reinvestment and Recovery Act of 2009 that was signed last week by President Obama did indeed include AMT relief for airport bonds. It says that any airport bonds sold in 2009, calendar year 2009, and calendar year 2010 will be exempt from the alternative minimum tax for their entire life. So as long as they're sold in 2009 calendar year or calendar year 2010, then for their entire 20, 25, 30-year life, they are exempt from the alternative minimum tax. That federal change immediately knocked a full percentage point off the rate that we were expecting to have to pay. So it certainly did pay us to wait for that, as we had told the council in December we were hoping would happen. It has now happened. It is law. So that is a major change, and it has also meant a major change in the ability to market the bonds, because there really isn't a market right now, even today, for alternative minimum tax bonds. There is, however, a significant recovery in the fully tax-exempt municipal bond market. In January, I spoke yesterday to our underwriter, which is Morgan Stanley, and they said they have done already in this year, in January and through the first couple weeks of February, have done a substantial volume in bonds that they have taken to market and successfully sold. In fact, they went so far as to say, our underwriter went so far as to say, a number of the deals they took to market, actually they upscaled them when they got to market. In other words, when they went to market, they were expecting to sell, say, $100 million, that $100 million sold so fast, so quickly, that they actually said, well, let's upscale it and make it $150 million. And so they actually upsized the deals once they got to market. And in the agenda report, I give you one example of such a deal, which was that on February 11th, the San Diego Regional Building Authority sold $137 million of tax-exempt bonds at an interest rate of right around 5.5%. So it's almost a miracle in a sense that we would now be looking, if the underwriter told me yesterday that if we were going to market this week, we could be looking at something in the 5.5% to 5.75% range, which is, it's amazing. Now, the hope is that we get to market as quickly as we can before some more bad news changes that. But that's really where we're at today, is that I have directed the financing team to put the pedal to the metal, as it were, and to get this deal ready to go to market as quickly as possible. We've been in touch with Standard & Poor's. We've given them an update on our schedule in terms of the bids. And we have an all-hands call this Thursday to get this thing going and wrapped up and ready to go to market as quickly as possible.
We have a question over here, Bob.
And as I said, I would expect that hopefully we could be coming to market in 3 to 5 weeks.
Colleen?
I was 3 to 5 weeks. It's exactly my question. What's the difference between the 3 and the 5, and how likely is it that we could be ready in 3 weeks, given everything you just said?
I would say that 3 weeks is a best case scenario. I give a range because of the Standard & Poor's thing. I'm not positive how long it's going to take them to get comfortable. They had sent us this lengthy questionnaire that they want us to fill out over the construction, and that really needs to be done by the contractor. So,
and in terms of waiting for their rating, is that something that needs to go on a council agenda? No, it's just a rating that they authorize. We don't have to officially accept it and take the time to do that, or do we?
No, that's
Right.
correct. In fact, just to reiterate and to make this very clear, staff currently has all the authority we need to sell the bonds when we think
Right.
it's in the best interest of the city.
So the moment we get the Standards & Poor rating, you could that day or the next day, if you can,
Right.
sell the bonds.
That's correct. Now it's going to take at least a couple weeks to finish up the updated review of the preliminary official statement and to get it published. But I think that my opinion is that the sort of the weak link in the timing is going to be the Standard & Poor's. And in a way, despite the fact that the delay in bringing you the potential bid award, I thought was going to be on the 3rd, it's now the 10th. Mm-hmm. In a way, that's good because it could shorten the time between bid award and bond sale. But it also means that
You're lengthening the time of when you're telling Standards &
for
Poor
Standard
when
&
to
Poor's,
who the contractor is.
Exactly.
So,
exactly.
second question, $40 million, the full cost, and as you mentioned, in the course of 3 to 6 months, which you gave as one scenario, should we not be able to sell the bonds in that period of time, you're talking a $5 million cash flow scenario that could be self-funded. Was that 3 to 6 month scenario one of your best worst case scenarios? Or, I mean, I guess what is the absolute worst case scenarios that we never are able to sell the bonds, or you can't sell it in 2009, 2010, and then the AMT option goes away?
Yes.
Can you just give me the range of
I will, absolutely.
risk here?
The absolute worst case scenario is that under federal tax law, we have 3 years, 36 months from the date of the first project expenditure to sell tax-exempt bonds to reimburse ourselves for the project costs, okay? So under federal tax law, you can do a project, and then you have up to 3 years from the date you started that project to sell tax-exempt bonds to reimburse yourself for those project costs, 3 years. Worst case scenario is we can't sell bonds in that 3-year window, and we're left either financing it ourselves, the entire project, for 25 years, or selling taxable bonds to reimburse ourselves at a substantially higher cost. That's the worst case scenario, 3-year window. Okay? The next worst case scenario is we can't sell the bonds within the 2-year AMT relief window. That's the next worst scenario. So really, let me bring it back to try to frame the decision point here, which is that the issue isn't whether to issue bonds and when to issue them. That's frankly been decided, and as soon as we're ready to go, if the market's going to be, if it is what it is this week, we'll be selling bonds in 3 to 5 weeks. The issue is whether we take the risk of awarding the contracts prior to the sale of the bonds. And in the agenda report, I talk about that there's really two sides to that risk equation. On the one hand, we could reject the bids and rebid it. But the fact of the matter is, and I'm not the engineer, and if you have questions on this, I'm certainly going to ask for some help. But I spent some time talking to Mr. Thomas and the airport people, and my sense of it is that these bids that we have in hand now are as favorable as we're going to get. Now, someone could argue, well, the economy's only gotten worse since then. Why wouldn't we get lower bids? I think that the risk really is that if we were to reject bids and bid again, that we would get higher bids, and maybe even substantially higher, by $2 or $3 million higher. That to me is that risk on that side. Then you have to balance that against, okay, we decide that we don't want to risk that. We like the bids we've got and we think they're worth holding on to. Then you've got to balance that against the risk of awarding the bids prior to having the financing in hand. And in my estimation, the risk of rebidding and getting substantially higher bids outweighs the risk of awarding the bids and expecting to go to the bond market within 2 to 3 or so weeks thereafter. That's the way I balance those risks, and I consider myself fairly conservative in that regard. I've done a lot of due diligence over the last week and 10 days, both with our financial advisor, Kelling Northcross Nobrega, and the underwriter, Morgan Stanley. And it seems to me that the bond market has, for municipal tax-exempt bonds, has been reestablished. Now, I hasten to add, these are, volatile times, and whether it's the nationalization of the banks or whether it's some shock from overseas and further economic shock that could affect the bond market, I can't guarantee that the bond market today is going to be the bond market in 3 to 5 weeks. But I think that that's something that, given the fact that we really do have a 2-year window for the AMT relief, given the fact that we certainly could finance this project even for a year out of our own resources, and frankly, I wouldn't do it for this reason, but there would be a plus side to that, is that we just talked about in the investment report, we're currently earning about, on new investments, less than 1%, and to the extent that the portfolio buys the airport bond, our airport paper, the promissory note, we'd be earning, 12 or 13%. No.
Wow.
We would be earning 6.5%.
Yeah.
Possibly 6. Okay.
5 3/4 is what I hear.
Mr. Pearson, don't get greedy.
Yeah,
on this.
no. Karen and Hazel drive a hard bargain, and they've beaten me down to no more than 6%. But so there would be, again, I wouldn't do it for that reason. It wouldn't make
Yes, you
sense.
would.
But it certainly wouldn't be something that couldn't be handled by the city, given the amount of our resources that we're blessed to have in our investment portfolio. As you recall, we've already loaned them $7.8 million to do the rental car facility, and they're paying as agreed. So that's, I think that pretty much sums up.
Yeah,
what
we have
I
a
wanted
question
to
over
say.
here.
Sure.
Yeah.
Me?
Yeah.
Thank you, Mr. Chair. Yeah, they're paying us 6.5%.
Yes.
Oh, see, there it is. Not 13, not 13. Okay, let me get this straight. We have these bids. They were surprisingly good. I remember elation all over Mr. Armstrong's face when that happened, and Christine was there too. We, in order to get a more favorable rating from Moody's, need to commit to somebody. The question that I have, maybe it's for airport staff, but maybe you can answer it, is the folks that we got the bids from are solid, reputable, well-known quantities that are respected, that can stand on their own, can stand up to scrutiny. It's not like we got some fly-by-night that gave us a really cheap, a bid on the cheap, right?
Excuse me. That was not an editorial comment.
If it
that's
was,
correct.
it's the wrong answer,
No, I
but
know.
okay.
No, that is absolutely correct. Now, I think I'm safe in saying that we had not done business with any of the bidders that submitted on this project. These bidders, again, Owen can correct me if I'm wrong, the scope of this project is so large
Right.
that it's frankly probably beyond the capabilities of many of the local contractors with whom we deal regularly. So we've not done directly business with any of these bidders, but we have done an immense amount of due diligence.
Okay.
And
So these are professionals in the industry of expertise
Yes,
of
we've
building
checked
airports and
references,
so forth.
we've-
All right. So that being said, we can have confidence in the outfit that we choose from this list of bids. All right. In order to get a more favorable rating from Moody's, Standard & Poor's, okay, one out of two, we need to let them scrutinize who is going to be doing this construction for all the reasons that you mentioned before, and I won't reiterate. So it sort of begs the question, doesn't it? I mean, it's sort of, well, I know that there's a gap between the opportunity to sell bonds for one reason or another. I'm not quite sure why we aren't ready to go. If we're ready to go and we've given you the authority, why aren't we just ready to go unless there are some documents that are time sensitive that you can only prepare as you prepare to go?
Yes.
Oh, yes? Okay. All right. So there's this gap, and so we run this risk of if the bottom drops out of the entire world even more than it has today, that we might be personally on the hook for $40 million. The chances of that are extremely remote, however, under the circumstances. We will be able to sell bonds, just at what rate is really the question. We're trying to time the market and getting a favorable rate.
Yes.
Right?
Yes, that's absolutely
Okay.
right.
So, in order to move forward here, it seems to me that Standard & Poor's needs us to have a contractor. So, is there really a question here? I mean, in order to get off the dime on this at all, we have to go ahead and move forward. We can move forward with confidence in that we have picked good professional people with expertise in this arena. We make Standard & Poor's happy because we've picked such a fine outfit. They give us a favorable rating.
Yes.
You get all your people together to, I see Rudy looking at me. But, and it seems to me like the timing will actually work out quite well. I'm not sure, in order to get Standard & Poor's to treat us well, we need to get off the dime with the contractor.
That's correct.
So even if we were ready, I mean, even if we were ready to go to bid, to go to market rather, I think we'd still be in the same pickle. So I don't see. I understand and I appreciate that you bring us this dilemma with the gap and that we make an informed yet calculated decision about this. But it seems to me that the order of how this is to proceed has been dictated to us in the situation. And I see the attorney nodding, and that always makes me happy. So that's where I am. This is kind of a no-brainer for me. I don't know.
Well, the one important factor here, I think, is the AMT ruling, and I didn't know what way that was going to go, but it came out the way we wanted it to. So that's a important factor for me, and that is a time-sensitive ruling. The other factor is that we spent a number of hours in a number of meetings looking at these financial models, and I've spent some time with Mr. Pearson offline here looking at the numbers, and the percentages that we're looking at have come in within the parameters that we were working with. If that weren't the case, then this would be a little bit different meeting today. But they are not only within the percentages that we were working with, but well within. I don't know what to say about the holding off and the bids coming in higher. I think that's maybe yes, maybe no. But we do have good bids and good enough bids that I doubt that we do much better. I don't think we do a whole lot better if we did any better at all. And there certainly is a chance that we wouldn't do as well. So then we get back to the uncertainty of the overall market in the United States and in the world financial market. And I've been in this field for almost 40 years now, and I've never seen a situation like we have right now. But I don't know that that's going to clear itself up in a timely manner to help us with this decision particularly. I think this uncertainty and fluctuation could go on for many months and maybe even years. So it seems to me, and I agree with Ia here, that given all these factors that we've talked about, and it isn't just today's meeting, it's over many meetings, that it only makes sense to go ahead and suggest to council that they proceed with the bid. And that's my opinion.
I'll just add that, well, first off, how smart I think we were in extending the bid period by 90 days because we have a whole new administration. We have a stimulus package we didn't know what it was going to look like in December, and the AMT ruling was huge, and we didn't know what that was going to look like at the end of the year, and it was smart for us to take that little breather. The changes that's happened since then makes me think that if we did not award the bids now and go out to rebid, between the AMT ruling that occurred after we got the bids and the stimulus package of now having new flux of money for projects, there might be more competition for some bigger projects that this money is being earmarked, well, not earmarked, but directed towards, that we might see a much significantly higher type of bid based on those two things. So I agree with my colleagues that we should recommend to council to move forward and award the bids, and especially since we are secure in who the contractor options are. And I will say, though, it won't come to us for 2 weeks, and past performance is indicative of future behavior, even in the stock market sometimes, in the sense that lately it's been a roller coaster. And if between now and 2 weeks from now, everything goes topsy-turvy again, we may have to have this conversation a little more detailed and just take a little more time on the 10th. Because like you said, things can happen at a moment's notice, and that might change the dynamic altogether. But given what we know now, I think it's prudent for us to move forward with this. So I'll make a motion to recommend to the council, basically, recommendation B, that the city proceed with the award of bids on the project prior to the sale of the project bonds.
I'll
second?
second that, absolutely. And I have a question. Even if we choose, we're not choosing now, but if the full council chooses to hold off on the bid award, given some of the things that were just mentioned, possibilities, the folks that would rebid this project, aren't they exactly the same list of people that we have today? Are there going to be new people coming to the dance?
No, my guess would be, while it's not my area of expertise, that Owen's going to answer this.
Knew I'd get you up here somehow, by hook or by crook.
Okay, thank you. Yeah, you never know who's going to come
Why don't you
out of the
introduce
woodwork.
yourself, Owen?
I'm Owen Thomas with the Public Works Department. And, when we bid a project, you never know who's going to submit a bid. And I would guess we would get a bid from somebody that didn't bid previously, but in general, the playing field is the same, all the big players are the same, and, we'd be likely to see many of the same bidders.
And we have the big dogs in the industry bidding on this project.
We do.
Okay.
We had 9 bidders
Yeah.
on this one.
Yeah, no, I saw the list, and it was impressive. I don't know who these people are, and the range was quite interesting, and they were all sort of around within a certain ballpark, so you know that somebody didn't just lowball the project.
Yeah, second
you know.
bid is only 34.9, so it's right in there.
Yeah, and they were all sort of around the same area, so you know that they're real, you know that this is a serious effort at a real bid. So
Okay.
I'm good to go.
Well, we have a motion and a second. Any further discussion? If not, all those in favor say aye.
Aye.
Motion carries. Thank you, Airport Department, Finance Department.
Thank you, Mr. Chairman.
And
members
it's
of the committee.
a great day and a red letter day for the airport.
It is.